everyone. This is Vishal from Equity Guru. And yesterday on October 13th, 2022, we witnessed a miracle on Wall Street. We were waiting for this inflation data for the month of September, came in higher than expected. Once again, the PPI data, which is the producer price index, also came in higher than expected. So usually it tells you what the CPI is going to be. So inflation, it continues to persist, even with the Federal Reserve taking interest rates up to 3.25%. Earlier this week, Cleveland Fed President Loretta Mester came out saying that there has been no progress on inflation. So the reality is, folks, that it appears as if interest rates will have to head higher in order to tame this inflation, unless we get some sort of major demand-killing event, which some people say could be, a recession, right, coming down the road here. But CPI for September increased by 0.4% for the month, beating expectations of 0.3%. And on a 12-month basis, inflation was up 8.2%, which is still under June's high of around 9%. But that inflation data is still, near the highest level seen since early 1980s. If we take out food and energy, core CPI came in at 0.6%, which is higher than the Dow Jones estimate of 0.4%. And core inflation is up 6.6% from a year ago. And it is the biggest 12-month gain since August 1982. So markets, were dropping lower at the open because the data came out an hour before the market open. But then randomly, markets reversed. And I'm just going to show you the daily chart here of the S&P 500. Obviously, we'll talk about today, the 14th. But, we had this big drop in the markets. And then all of a sudden, this huge, multiple hundred points rally where markets were like down over 2%, reversed, and then closed near 3% gains for the day. And a lot of people wondering what the heck is happening, because the fundamentals basically remain unchanged, right? It does look like the Federal Reserve is going to have another large rate hike in 3 weeks' time, and rates will probably continue to move higher if the Fed is going to be hawkish and have this aggressive tone at the November meeting. So a lot of people are trying to make sense of why markets popped, right? What was the big reason for it? I think, as I said, fundamentals are the same. I think this is more of a technical thing where you were just close to a support level. We've had 1, 2, 3, 4, 5, 6 red days in a row. And I just think that the markets needed a bit of a green technical relief rally. And that's really all it is. As you can see with today, the momentum from yesterday's big green days aren't carrying through. And that's usually a sign that, it was just a relief rally. Although other people are talking about, the plunge protection team, the PPT, that we know exists, maybe jumping in there to try to keep stocks buoyed. But I want to talk about what I'm seeing here on the technicals. And some of you might already be saying, oh, why do you have this blue resistance line, cutting through recent price action here in the middle? I'll get to that in just a minute. But I know a lot of people probably have their charts set up like this, where it does appear as if maybe there's going to be a double bottom on the S&P 500 on the daily chart. However, if we break below 35.73 here, we're going to continue lower. But I'm going to keep my resistance line here, and I'll show you in just a second. But very quickly, for you bulls out there, if you are going to go long in the markets, our level here at 3,800 has not changed. That's the level that we want to see taken out in order to trigger some sort of double bottom pattern. And the similar sort of setups can be seen here on the NASDAQ, although you can see here my resistance is being rejected. And don't worry, I'll get to that in just a minute. Same with the Dow Jones. It looked like we had a double bottom type setup, but we are now just getting rejected at that resistance line. And then the Russell, which is, I think, sort of the interesting one, because it's been ranging actually at its lows for some time here, and it's just waiting for a break for either direction, right? To give us a breakout higher for a reversal, or if we break below support here with a continuation lower. So going back to the S&P 500, let's take it down to the higher time frame, the weekly time frame. And as you guys know, the longer term time frames, there's more strength to the technicals when you look at the long-term charts versus the 5-minute or the 1-minute chart. So I suggest, slow things down, have a broader view with the weekly chart, and then work your way down if you want to do some day trading. But I like to trade mostly on the weekly and the daily charts. Those are my preferred time frame. And you can see here on the weekly chart, all this set us up for. So these past 2 weeks, yes, we've had a big pop. We had another rally, but these past 2 weeks, all it's been is a retest of this 36.75 resistance zone, which we broke down below on the week of September 26, 2022. And the markets have just been trying to reverse this breakdown, which requires a weekly close above this 36.75 level. And you can see the seller stepped in, we rejected, and they are rejecting it once again. And if I show you the NASDAQ, similar instance with that weekly chart being rejected. On the Dow Jones, you can see here, very similar as well, where we're just retesting. And it does look like, we'll probably do something like this. And then also on the Russell 2000, which, as I said earlier, is still holding above its support zone. So the weekly charts are hinting at lower markets. However, as I said, if we do get some sort of range or pop, and then say a week from now, we see a weekly candle close above those weekly resistance levels, then we can start building a case on or for a reversal on the daily charts of the equity markets. But the levels that I've mentioned in our market moment articles for a bullish invalidation, or sorry, for a bullish reversal remain the same. We need those breakouts above this level. Still far, long ways to go before I turn bullish. But that one chart that we always talk about that you should be watching is that US 10-year yield, or that TNX, which basically is the one chart you should be watching every morning you get up if you want to determine where these stock markets are going. Because as yields, or as interest rates head higher, or as the market predicts interest rates are going to head higher, it's going to put more pressure on the equity markets or the stocks. And you can see, take a look at the candle on the 13th of October. Very wicky candle there, but essentially we had this breakout, which coincided with the stock markets breaking down, but then this tremendous reversal, which saw the 10-year yield close below this resistance level here that we were watching at around the 3.95% level. And with that, we saw the equity markets bounce higher. Look at today's candle. Now we are doing the opposite. We are now again climbing back above 4%, back above our 3.97 level. With a close like this, that would be a breakout, which wouldn't be very good for the stock markets in general. So as this yield chart heads higher, it will put pressure on the markets. But if yields do drop or reverse like they did during these days here, or if they just range, then you could see the markets beginning to, have a relief rally. Let's just call it a relief rally for now. So keep an eye on this chart. You can see this breakout is going to be important. We are still watching the 3.9% level here in order to actually see some sort of significant drop in the yields, which would obviously impact the equity markets. But as of now, from the technical side of things, watch to see if we get a breakout close here on the 10-year yield, which of course will mean very likely these equity markets continue to drop lower. And I'm recording right now. We still have like 2 hours and 20 minutes left on the trading day, which is plenty of time to see the equity markets either just continue to range or perhaps see us close below these body lows from this week, which would set us up for quite the bearish week following. And you can already see with the NASDAQ, we are actually already closing below the body lows for this week, which would be quite bearish for the NASDAQ in general. So keep an eye on these closes. I know a lot of people were quite, maybe not upset, but I think I know personally a lot of people that were taken out of their shorts because of yesterday's major rally. And I think, you want to sort of look at these longer time frames and look at these lower high levels and resistance levels on the longer time frames, where you want to place your stop losses and then just ride the trend either down, or if you do get a reversal at some point you ride the trend upwards. But as of now, as I said, all our technical levels are being met. Everything else is really just noise, and a lot of people are trying to explain, oh, why are markets jumping up like that? But I think, it's very important as traders to sometimes keep that noise away, shut it out, and stick with your criteria and your trading strategy, and you'll get rewarded as we've been getting rewarded with our trades. So that's it for me, folks. Give this video a thumbs up. Be sure to follow us as well if you're interested in more technical charts. And I really want to know in the comments below if you guys think that this is actually the bottom, if markets are going to bottom here or just range here for a couple of days or weeks before the next Fed rate decision, or are you continuing to add to your shorts with yesterday's relief rally going forward? So let me know in the comments below, and I'll catch you guys all in the next chart attack video.